Good morning and good evening to those folks in India and elsewhere. Welcome. We have a record-breaking registrations, nearly 900 registrations for this very insightful talk today by Dr. and Professor Viral Acharya. Viral is not only a noted economist, but a person of many accomplishments, plus an IIT Bombay alum. Today's talk includes registrations from not only some prominent economists, but also fellow IIT Bombay alumni here and in India, and their friends and guests. Thank you all for joining us today. I am DC Agarwal, President of IIT Bombay Heritage Foundation, which has organized this talk. It represents IIT Bombay's US-based alumni, and this talk is also supported by IIT Bombay Alumni Association based in India. For those not familiar with IIT Bombay Heritage Foundation, it has some 5,000 members across US. We have chapters in Bay Area, New York, Chicago, Atlanta, LA, Seattle, Michigan, and many other cities. We have a very active alumni base in US. In a normal year, we would have held many local meetings and talks. However, this year, in lieu of such meetings, we decided to have these HF talks to engage with our alumni and friends and keep them informed on various current topics. This is a third talk in this series. Just a quick and brief plug for IIT Bombay Heritage Foundation. Each year, it collects and donates somewhere between $1.5 to $2 million per year to IIT Bombay. Interestingly, given the COVID situation, this year in a month's time, we raised and donated over $300,000 to IIT Bombay to buy 500 laptop computers and broadband connections for needy students. In our own way, a small but great way to bridge that digital divide and hopefully also help revive India's economy. Now a brief overview as to how today's session will go. After my remarks, our moderator, Mr. Gagan Singh, will introduce Dr. Viral Acharya, have him make his remarks, and then engage him on his ideas to revive India's economic growth. In the last 25 to 30 minutes, we'll have Viral Acharya respond to audience questions. Now, this is important. Please submit all questions on the Q&A tab on your screen. Given the large number of registrations, it's important that if your question is already listed, please just vote on that question rather than add as a separate question. Please limit the chat tab for comments only and not enter any questions there. And select all panelists and attendees so everyone can see your comment. Another important note, this talk is being recorded and will be available on YouTube and other social media. It will also be posted on the iitbombay.org site, which IIT Bombay Heritage Foundation uses. Before next step, I also like to thank my HF team. We are a bunch of volunteers who do this stuff. So I'd like to thank them for the time to arrange this talk. Now let me introduce our moderator for today's talk, Mr. Gagan Singh. He currently serves as Chief Investment Officer with PNC Financial Services Corporation, which is one of the world's largest financial services entity. He also directs its economics group there. Gagan too, like Viral, is an IIT Bombay graduate receiving his BTech in electrical engineering in 1995. In US, he received his master's degree from University of Maryland Business School. In addition to serving on many nonprofit boards like Pratham, he currently serves on IIT Bombay Heritage Foundation Board and on its finance committee. Please welcome Gagan.
Thank you very much, DC. Good morning, everybody, again. Welcome to a very special IIT Bombay event. And thank you for taking the time on a Saturday morning to be with us. As DC mentioned, we have a very special guest joining us today, our very own IIT Bombay alum, Professor Viral Acharya. Viral needs no introduction, and his accomplishments are too many to list. But I would like to take this opportunity to briefly say a few words about him. Viral Acharya is the C.V. Starr Professor of Economics in the Department of Finance at New York University Stern School of Business, and an academic advisor to the Federal Reserve Banks of New York and Philadelphia. Prior to joining Stern, he was at the London Business School as the academic director of the Collar Institute of Private Equity. Viral served as a deputy governor at the Reserve Bank of India from January 2017 to July 2019. And he was in charge of monetary policy, financial markets, financial stability, and research. His speeches while at the RBI were recently released in the form of a book titled Quest for Restoring Financial Stability in India, which also includes a new introductory chapter, Fiscal Dominance, a Theory of Everything in India. Viral is a brilliant mind, and I have had the distinct privilege of knowing him from the time both of us joined IIT Bombay in 1991. And I must admit that I have been in awe of his extraordinary academic achievements ever since. While Viral does not include this in his official bio, I think this group here on the call today will appreciate the fact that Viral was JE number 5 and was the president's gold medalist of our batch. Viral is a very dear friend, and it is my great pleasure to welcome him today. Good morning, Viral.
Thank you, Gagan. Absolutely delighted to be here, interacting with you, the rest of the IIT Bombay Heritage Fund team, and especially all the dear friends, many of whom I can recognize as they are signing in. Thank you so much for joining, and I hope all of you and your loved ones are doing well and staying safe in these challenging times. I look forward to the Q&A as well as the interaction before.
Thank you, Viral. Let's turn to the conversation now. You are a role model, I think it's safe to say, for so many people. Before we dive into the topic for today, I think our audience would love to hear from you about your amazing life journey that took you from a computer science lad in Bombay growing up, all over the world, New York, London, and then back to Bombay as the RBI deputy governor. So can you tell us a little bit about how this came about?
Yeah, I don't know if I should really be a role model for anyone because my journey has been mostly accidental rather than a planned one. But you know how it goes. You take the JE exam. If you get a decent rank, then you want to do computer science. So thoughtlessly, I also took the JE exam and took the computer science department role. But I think as time went by, especially at IIT, I realized that at least the stuff I was doing, which was more mathematical, combinatorial computer science, that neither did I have the aptitude for it, nor was I super excited about it in the end. And I think maybe it was a good realization to have in my third year or the fourth year of IIT that perhaps I'm looking for something else to pursue. And then it so happened that I took an elective with Professor Pushpa Trivedi in the economics department. I consider her course in international finance as really the turning point for me. I figured that it was a subject that was easier for me to relate to. It kind of felt interesting that in some ways, all this stuff is happening at a very macro level, global trade and global central banks. And yet somehow in the end, it goes and touches the common man in the street, at least some of the times. And I always liked this micro and macro intersection that, economics, as many people don't always get into the origin of the term, but economics actually comes from the Greek word economia, which is about the household's wealth management. And very often economists actually don't take much interest in what's happening to households. But I've always found this intersection of micro to macro very interesting. Anyways, I had already applied for PhD in computer science when all this, self-discovery and self-realizations dawned upon me. I applied to NYU, but it was a bit too late for a degree in finance. We had a family friend who had just completed a PhD in finance. And his advisor was Professor Marty Subramaniam, also an IITian from IIT Chennai, and then IIM Ahmedabad, who in the end was my eventual PhD advisor. So I went to NYU. I started taking some courses here and there in finance. I was actually like you, Gagan. As you know, I wanted to be in industry initially. I was on the floor of JP Morgan 3 summers in a row to figure that out. But in the end, I realized I'm a bit lazy to go to work every day in the morning at a fixed time and be there reporting to bosses and so on. And I didn't like the lifestyle as much, even though the work was very cutting edge. So finally, I pursued my PhD. I took on, but I think the JP Morgan experience was very, very important because in 1998, when I was there, 97, 98, we had the Southeast Asian crisis, then the Russian default, and we had the long-term capital management hedge fund about to blow up. In fact, I remember a day on the trading floor. Again, there were questions about 2 of the entities that eventually failed, Bear Stearns and Lehman Brothers, because they again had large positions in mortgage-backed securities at that time and were that those markets were not functioning very well during the LTCM crisis. And that was the time I realized that maybe financial stability is perhaps very, very important. The financial firms, the banks, they have to really be in good shape at all times, because otherwise this lifeblood of the economy, the money, the liquidity that moves through from banks to the households, that can choke and then prevent the growth of the economy. So that then became my PhD topic. And, for the longest time, if I could say that, I was waiting for a big crisis to happen so that my work would become relevant to the rest of the world. And I'm just joking, of course. And then, of course, there was the global financial crisis. And then suddenly, my 7-8 years of research found a voice, so to speak, because people started paying attention to banks, institutions, central banks, and why they are important to be working well at all times. So, to cut a long story short, I think it has just been sheer luck that I took this course when I was at IIT, and I found the subject that I feel very passionate about. I do feel I breathe it. It keeps my mind occupied all the time. And so, at least when I speak to other students, normally what I tell them is, don't stop this process of questioning yourself and exploring yourself. Are you doing what really is your calling? Because if it's not, it's never too late to switch. And as long as you have found your calling, then everything else then falls in place. Last point I would add here is that I think probably the job at the central bank was a natural culmination of whatever I've been doing. It's always been about financial crises, central banking. For someone who was doing finance and economics in late 90s, I think Dr. Raghuram Rajan, who's at University of Chicago, another IITian, IIT Delhi, IIM Ahmedabad, was clearly a very big source of inspiration given his meteoric rise in the field of finance and economics. He then went on to become the IMF chief economist and then the governor of the Reserve Bank of India. So at least you started believing that, we can do it. One can actually make these things happen. And so in its own ways, IIT has played such a crucial role, first in deflecting me away from computer science, if I could say that. But then through the IITians who have been in finance and economics, actually giving me the right focus, the right questions, and I would say the right ambition of actually doing something in the policy space for India.
I think our audience is very quickly getting an idea that in addition to being, extraordinarily brilliant, you're also extraordinarily modest. I envy people, with modest computer science aptitude, you can go on to win the gold medal. I envy people who, the others who don't have even that modest aptitude. So we leave it at that, Viral. But it is great that you've gone on to achieve so much in the field of finance coming from IIT. Well, let's turn. Today's discussion is really centered around your recent book. I just want to show a copy for everybody's benefit. Please order yours. It's available on Amazon, and it is really a wonderful read. Even if you're not a policy wonk like I am, or certainly Viral is an expert, I think you will enjoy why this is not only a good read, why the book is really relevant, not only to what is happening in India, but more and more what is happening around the world. But we will get back to that in a few minutes. So the book is called Quest for Restoring Financial Stability in India. That begs the question, Viral, is India financially unstable?
I explained this in the book quite clearly that in India, what you see is a silent banking crisis. And I stress the word silent here. And what do I mean by that? As you know, India has a large presence of public sector banks. Many of these banks were nationalized in two waves in late 60s and 70s. And they have been now nationalized for a stretch of 40 to 50 years. And what that means is that the sovereign backing on the liabilities of these banks, notably the deposits that the savers have in these banks, is very, very high. In fact, even today, if you run a survey in India, the household trust in putting their deposits into public sector banks is understandably greater than that it is elsewhere. And you look around the world, there's a reason why banks are sometimes have the name of the country in their name, because that creates trust in the mind of the saver, the depositor, that, oh, this is almost a national champion. So there's a reason why it's a State Bank of India or the Union Bank of India or the Bank of India and so on. Or sometimes, they will have regional names because that is what implicitly builds trust. And of course, in case of nationalized banks, that trust is reinforced and cemented by an explicit backing in the letter of the law that, these are owned by the government of India. Now, so why is it that I call it a silent banking crisis? Because these banks have had repeated failures in their underwriting standards. They've gone through so many leverage boom and bust cycles. First, there was a huge, bust in the textile. Then the real estate sector appreciation got them out of it. All the malls got built with the real estate that was owned by textiles. And so, the real estate boom in big cities of India got the banks out of that. Then post-global financial crisis, we had a huge fiscal stimulus. And it was, I would say, a combination of a fiscal stimulus and perhaps even behest lending, banks being explicitly told that you should lend to infrastructure sector, you should lend to power sector, steel sector, and so on. Because global growth slowed down, but India wanted to keep showing that we can grow at 8%, 9% per annum. And then the convenient thing to do rather than undertake a new set of reforms was to get the banks to actually lend very aggressively. So this was a time when credit growth in India was at 15%, 20%, 25% per annum. Those are extraordinarily high growth numbers for increase in bank credit in a short period of time. But because of the poor underwriting standards and the lack of monitoring capacity inside the public sector banks, lending again went awry. And now we are saddled with actually over 10 lakh crores, 10 trillion rupees of bad loans, mostly in public sector banks, but also spread somewhere in private sector banks. Now, this kind of a non-performing assets problem, as it's called in banking, where banks have lent money, but the recoveries are going to be very low. In India, typically a bank will recover at best 30 to 40 paisa on a rupee on average, which is very low for a bank loan recovery by international standards. And this also happens in a very protracted manner because our bankruptcy courts are so slow that typically the recoveries will come after 6-7 years. So this is practically extreme, it's debt that you have to write off. Now, in spite of that, depositors are not pulling out their money from these banks. And why is that? It's because of this trust and the safety implicit in the backing of the sovereign that's behind. Now, the key point is that this doesn't mean that your financial sector is fine, because the public sector banks still have these losses. They have not been marked fully on their books. So, the market values them at only between 30 to 60% of their book value, which is a sign that they have not taken 40 to 70% of the write downs. And sometimes the analogy that is given by one Yale professor, John Giannakopoulos, is that, a person is coming down from the 100th floor, he's going to reach the ground. But when he's on 85th floor, you say, oh, abhi to 85th floor pe hai wo, he has not yet come to the ground. So that's the way the books are unfortunately marked in India. But these banks are not lending well. They are right now extremely risk averse because the government doesn't have any more capacity to keep bailing them out. If I just give you a sense of the numbers, just over last 10 years, government has injected over 4 trillion rupees. And the opportunity cost of this money, which is if you had invested this in the index or in private banks, is another 3 to 3.5 trillion rupees. So we are talking about over $100 billion that has gone into these banks. Now, that's the kind of cost you expect when you have a crisis. But we have not had a crisis, and yet we have already incurred such high costs. And yet, the job is not done yet because we have so much more to recognize as bad loans. So these banks are not lending well. First, they were mainly lending to the defaulted firms themselves. It's a practice which in banking is called as evergreening, which is you just extend the maturity of a loan which is coming due. The borrower can't repay. You simply extend it by another 3 or 5 years and pretend as though everything is fine. This was a practice that happened in Japan in the 90s, in Europe over the last decade. And you are just basically throwing good money after the bad. The economy doesn't recover because credit is very cheap for the worst guys. And by implication, the credit is not as easily available to the healthier firms and the households.
No, I think, Viral, there is no doubt that in your book, as you lay out, that the role of public sector banks is central to the challenges that you describe and the financial instability. But if I may, I want to take a step back. I think you tie this bank problem in a wider web of issues. You in your preface chapter, you talk about fiscal dominance and why it is essentially explains not only the banking issues, but many other structural issues that India is facing. For our audience, can you take a step back and tell us what is fiscal dominance and why is it so dominating?
Yeah, absolutely. And in fact, it is deeply tied to the points I was just making earlier, which is why is it that it's hard to now fix the public sector banks at this point? Because you require a huge wave of capital injection again if the government is going to keep owning these banks. But the government is right now was already at 8 to 9% of its GDP in deficits. So, the borrowings that it has to undertake over and above the tax collections. And post-COVID, it's most likely these numbers are going to rise to 14, 15% of GDP because, GDP is coming down. So tax collections will drop, as well as relief and repair efforts are underway in different states, the most affected states, and for the most affected citizenry. So there is no space anymore to actually keep throwing good money after the bad. So what is fiscal dominance? Fiscal dominance is a situation or a state of the economy of a country where the governments have borrowed so much and are running such large deficits that they start dominating the policies of the central bank to ensure that they can keep rolling over their debts very easily. Now, in the traditional macroeconomics, this is an idea that goes back to 80s to macroeconomists Thomas Sargent and Neil Wallace. They said that, what will happen when a government is running these levels of high debts and deficits is that they will say, why should I take the difficult task of restructuring my debt? Why should I cut back on my populist programs? Why don't I get the central bank to engineer inflation? And through inflation, I'll impose a tax on the savers because now with the money that they have invested in my bonds, they will not be able to buy much of the real goods in the markets. And effectively, I have debased the value of these bonds. So inflation was thought of as a tax that the central banks could engineer and move away from their traditional objectives of keeping inflation low. So that's the traditional notion of fiscal dominance. What I'm trying to argue in my book, and this is, I think, a novel point and its main contribution, is that when a central bank is an all-purpose central bank, like the Reserve Bank of India, and what do I mean by that? So Reserve Bank of India is the deposit insurance for the savers in the banks. It guards the external sector stability, so it defends a very rapid depreciation of the Indian rupee. It is also the debt manager for the government. It actually runs the auctions of government debt in India. It is the supervisor and the regulator of the banking system. It also sets the rules for the government bond markets in India, which is how they are going to trade, how are banks going to record their gains and losses on these bond positions, etc. So the Reserve Bank of India is a very complex regulator with a more I would say a bigger spectrum of functions than I would say most other central banks do. So therefore, what fiscal dominance does in India is, at the cost of exaggeration, I have called it a theory of everything in India, because all financial sector policies in India, I find, are ultimately steered away from the long run objectives of the central bank. The long run objectives are protecting depositor interest, safeguarding the value of the rupee, keeping inflation at bay, but they all start getting steered away to ensuring that the government can keep running its large borrowing and deficit programs and at low cost. But all this happens at the cost of long run macroeconomic mismanagement or fragility, because depositors are not safe, as we just discussed, because now we don't know where is the money to put in there. The rupee can get depreciated very quickly if inflation starts running away. And of course, inflation, if it starts running away again, all the gains we have made in the last 10 years that people are saving money, instead of it going into gold and real estate, now it's entering the stock market and bond markets. But if inflation starts running high, all this financialization of savings could also go away. So the main point of the chapter is really to highlight that the fiscal situation of India is now permeating India into all the arteries of the central bank's regulatory apparatus. And it risks clogging these arteries and preventing the lifeblood, which is finance, from reaching the households, the real sector of the economy, and all actually just staying blocked for one entity, which is the balance sheet of the government.
So let me make sure, for the benefit of our audience, we get the picture right. Essentially, you have a fiscal authority, the central government, that wants to continue its profligate ways, continue spending programs so they can win the next election, which is always around the corner. And as a result, they don't do a good job of regulating banks, which then go on to create NPAs, and bank lending, which is the lifeblood of the economy, suffers when these loans go bad. It also results in poor macroeconomic policy, poor monetary policy, which results in inflation, which is obviously a big problem, not only in India, but emerging markets globally, or has been for 5 decades. I think we're getting the picture here. Let me bring in the central bank here, because I know you talked a little bit about the banking system, which is public sector banks. And I know you are very passionate about an independent central bank, and the autonomy of central banks around the world, including in the US, is now under threat, which I think can create a lot of challenges. You gave a lot of interesting speeches, when you were there, which are compiled in this book. But the speech that really caught my attention, and I think the world's attention by far, was your, A.D. Shroff Memorial Lecture, where you made an impassioned case for the importance of an independent central bank. I quote, "Governments that do not respect central banks' independence will sooner or later incur the wrath of financial markets, ignite economic fire, and come to rue the day they undermined an important regulatory institution." Strong words. Why is the autonomy of a central bank so critical, not only in India, but give our audience a flavor for why that is such an important issue in managing macroeconomic stability across countries?
Yeah, so the traditional view on this, Gagan, is that it's because the central bank is a technocratic function It requires certain expertise, understanding the economy, how to intervene in markets, how to do the rate setting, doing all the modeling for the economy's inflation, growth prospects, financial stability, and so on. My pitch in the Eddie Memorial Lecture was slightly different. It was actually saying that, listen, for countries to grow well, what has been shown is that it's really about the quality of your institutions. It's about the quality of judiciary, the enforcement of contracts, whether the elections in a democratic system are run freely and fairly or not, and so on. And what is the primary rationale for this being the observed evidence in long checkered history of rise and fall of nations, as many of these books are trying to explain, is really that governments can have very short horizons at times. The analogy I gave in that lecture was them playing a T20 sometimes. That happens when short-term electoral pressures arise. Depending on the country you are in, it can happen almost every quarter, or it can happen once in 3 or 4 years. But when these horizons become very short, they have a tendency to use central bank policies and especially credit growth in the economy to pump prime the economy and posture it as though there is a lot of activity in the short run. And I think T20 is a good analogy because it's like, you come swing the bat a little bit here and there, you'll get a couple of sixes, all the cheer leaders start and come out dancing, and, the crowds are entertained. But an economy is not playing a T20 most of the time. It's playing what I consider as a test match. You have to take it session after session. And so the analogy is, that of Rahul Dravid to me, which is, how does he get the team to play a test match well? Because he becomes the sheet anchor. He drops the guard. And once he's there, he knows where his off stump is, doesn't chase a ball outside the off stump, however bad it is, because he knows while it could be a very exciting shot, it's also possible that I throw my wicket away and then the entire team could collapse because it's batting around me. So the same way I think of a central bank's role as trying to maintain this long horizon for the economy. And to me, it is an institution that should be put on a similar pedestal as these other institutions I was talking about, the judiciary, the election commission, the enforcement of contracts, bankruptcy courts, and so on. Because when the government horizons get short, the financing of the economy through the banking system can really go haywire. In fact, United States is a good example. It's very clear that subprime lending was pushed in the United States as a part substitute for the loss of jobs that was actually happening in the 80s and the 90s. And then, of course, the whole thing combined with private sector excesses to lead to the global financial crisis. But this has been seen the world over. And I think the central banks that give in or are forced to give in actually risk entertaining growth aficionados in the short run, but giving up the long run anchoring of the macroeconomic stability of the economy. And so I was pushing very hard for this. And in fact, interestingly, the lecture starts with the example of Argentina, where the central bank was compromised with consequences in the markets. There are examples throughout the lecture of actually an economist, Barry Eichengreen, being worried about United States. When open discussions about the government wanting the Federal Reserve to compromise on interest rates, choose negative interest rates, etc. started. There are examples of countries such as Turkey, for example, where the monetary policy appears almost explicitly compromised under pressure from the government, and with not so great outcomes in the end. And so my last thing was really a warning for India that we have made great strides in the last 3 decades in moving away from a centralized country to being more decentralized. Actually, the Reserve Bank of India is a much stronger institution in some ways through its processes. We have an explicit inflation targeting framework like in developed economies, which is actually not that common in emerging markets. I think this is a great achievement of Governor Rajan and Governor Patel during their terms, and that we really need to safeguard this institution, because if you compromise it, you might not have its credibility precisely when you need it. And my sense is we are currently at a moment where we need the credibility of the central bank to be very high, because the government is going to have to borrow a lot to come out of COVID. But you need that the investors have confidence that the central bank will not allow inflation to run away.
That is such a great explanation. I want to just follow up for a minute, if I may, and go back to your cricket analogy. There is no doubt we can't shy away from the fact that T20s have become much, much more popular and Test cricket is losing relevance. Now, that is too high a price to pay when it comes to institutions. Can Rahul Dravid be replaced by Virat Kohli? And what I mean by that is, even in this world where attention spans of the population are small and people are becoming more short-sighted, and certainly politicians exploit that, what policy prescriptions would Governor Acharya want in place, specifically with respect to RBI, so that we can actually enjoy T20s, but also not lose sight of the test match going on in the background?
Yeah, I think I would say, let me first focus on the RBI. And if there is time, Gagan, I would also like to talk a little bit on what needs to be done on the fiscal front, because,
Sure.
I think we can't at present address India's issues without actually addressing the real source of the problem, which is that the government is trying to do too much and borrowing too much in the end. But let's stick to the RBI first. First and foremost, I would say that RBI needs to be allowed in the letter of the law to regulate and public sector banks the same way that it can private sector banks. The book has a masterful foreword by Dr. Y.V. Reddy, former governor of the Reserve Bank of India, and I consider his foreword the best part of the book. In fact, I've read it several times already. He's a very witty person, and he has this nice analogy. He says that in 70s and 80s, the government, the central bank, and the public sector banks functioned like a Hindu undivided family, where no one kept anyone's proper accounts. Now, that time it was fine because there was no private sector to talk of. It was a nationalized economy, but we are not a nationalized economy anymore. We have private sector that is what is generating the high growth since the 90s. And so we need to keep the losses of public sector banks at bay, because we need to allow the rest of the private sector to get loans from them at reasonable rates. Right now, what is the problem? The problem is that the Reserve Bank of India Act and its regulatory powers through the Bank Regulation Act, these are overridden by the Banking Nationalization Act of the 60s and the 70s, when the banks were nationalized. That needs to be changed so that RBI, in the current form of the public sector banks, can discipline these banks well. Second, I would say the RBI needs to adopt more rule-based decision making. So, for example, in inflation targeting framework, the RBI is told you can change your policy rate such that you are targeting 4% consumer price inflation with a certain band. And there is democratic accountability that if you don't achieve this band, you have to explain to the parliament what were the factors that led you to this. And there's an exception allowed. It says that you should also pay attention to growth. To me, this is a great institutional arrangement. It says it lays down very precisely for the unelected officials what they are supposed to do, what is the instrument they can use, what exception is allowed to them, and if they fail in their duty to achieve the objective, they have to provide a testimony to people at large through the elected officials of the people. We need to adopt this, especially in bank supervision and regulation. Right now, what is happening is the reason why we are able to kick the can down the road whenever public sector banks make losses is because there is tremendous discretion in the recognition of losses. As I was saying, you just keep saying, oh, no, the person is still on the 85th floor. He hasn't yet come down to the ground. Then you say, okay, abhi to 70th floor pe aaya hai, it's still not come down. So there's too much discretion, and this needs to be rule-based so that RBI ties itself to the mast, as the analogy from Homer goes. You tie yourself to the mast of the ship so that when the sirens are calling, you don't have to give in to that temptation, and that would discipline the central bank. And the third thing I would say is that why actually recognize the loans when they have gone bad? In most countries, the recognition of loans happens in an anticipated and smooth manner ahead of time. You should start collecting information about the quality of the borrowers ahead of time and start providing for the losses in advance. And this way, what happens is that when the borrower actually defaults, the banks actually want to get the recovery on their loan so that they can write back what they've already provided for on their balance sheet. In India, the entire incentive system is topsy-turvy. all the provisioning happens at the end. And so there is no incentive to recover any money from the borrowers. And therefore, you have tremendous fraud through this evergreening activity. And you have a tremendous loss of taxpayer money because the public sector banks are ultimately holding the deposits of the savers. So those are the three critical changes I would recommend on the RBI. And if there is time or in Q&A, I can talk about the fiscal measures that perhaps are needed at the present point.
Yeah, why don't you spend a couple of minutes on the fiscal measures before we move into Q&A, because I think that's a central portion of your book as well.
Yes, yes. Thank you, Gagan. The big conundrum right now is that clearly the COVID is a very large shock. It has displaced a large number of people from their jobs because discretionary expenditure by those who typically spend more beyond their essential expenditures are heavily down. And relief has to be provided both on medical front as well as on the economic front. Now, India is at the cusp of investment grade rating. We are just a notch above being downgraded, and if the downgrade were to happen, we would go into the junk or the sub-investment grade category. Now, this has led to a little bit of a paralysis, so to speak, on the fiscal side, which is that, we have to be fiscally very prudent. And I think it is a reasonable concern to have. So I've been thinking about how can India undertake expenditures that are needed right now, while giving confidence to investors, rating agencies, and markets that in 3 to 5 years' time, we are going to be on a better path. Okay. And for me to do this, so therefore, in a way, India has to first provide a bridge to a point in future. It has to show that we are building this bridge. And if they do that, the markets will actually give you the money at reasonable costs to undertake the essential COVID expenditures right now. So what are the 3 steps I recommend in the book? One is that we don't have an independent bipartisan fiscal council the way a congressional budget office is there in the United States. What does the congressional budget office do in the US? It vets all of the government's programs and assesses how much spending the government is going to incur, what taxpayer money is going to be required down the line. In India, we don't have this discipline. So programs get announced annually in the budget. They are always made under extraordinary growth assumptions. We always fall short, and then the fiscal deficits keep slipping year after year after year. Second, we are not very honest about where the borrowings are taking place for the government. The government borrows on balance sheet, it borrows off balance sheet, it will borrow through public sector enterprises and then transfer that money to another public sector enterprise. And because of that, sometimes it's even hard for a central bank to know what is actually the true deficit. As Dr. Reddy points out in the foreword of the book, and as I have noted in the last chapter of the book, there is in India now a difference between an official deficit and a true deficit. And the gap is now very, very large. So we need to provide greater transparency on how much total borrowing the public sector is doing. That's 2. And third, and most important, I would say, the government just needs to get out of a large number of sectors. It needs to just divest left, right, and center out of the non-strategic sectors. And I would add here banking, insurance, and other parts of the financial sector. The government has no business to be in this, frankly. We have been in this public sector banking mode for 50 years. There is nothing to write home other than huge taxpayer losses decade after decade. Even the basic goals of development and financial inclusion are now being performed better by the private banks or microcredit and microfinance institutions than it is through public sector banks. And this way, they would also reduce the borrowings that they have to undertake each year. So I think India needs an institutional fiscal reform package. And you announce the package that will allow you to borrow more today, because then the markets will have confidence that you are going to be on a better path in 3 to 5 years' time.
Thank you, Viral. We are going to try to wrap this up, this part of the program shortly. I hope Vinay will get to the outlook for growth post-COVID, which I think is of interest to many of our people in the audience. But I would like to end on a personal note. First of all, thank you so much for doing this, and this is going to continue in Q&A. But I think people must have gotten a sense that you're a man of many talents, including cricket that we talked about. What we didn't talk about is how good a singer and musician you are. And we won't put you on the spot and ask you to sing, but I do want to ask you a question. One of the songs that you used to sing in Surbahar, which many IIT Bombay people know as one of the more entertaining programs all year, is Musafir Hu Yaro from Parichay. For Musafir Viral, what's the next stop?
No, I think as that song goes, what happened in my case was that मैं मुड़ा तो साथ था but राह मुड़ गई. So so no, I'm just enjoying my research. As I told you, I feel very passionate about this subject, the central banking, financial stability, how it interacts at one level with the government and at another level all the way to the household at the last mile. I keep learning from it. Hopefully, some of the research I do is useful to central banks in some of the policies they are designing right now to come out of COVID. What next? I have no idea. Maybe, I would be very delighted to continue to contribute to Indian policy making in some way, if not now, down the road. There are also interesting jobs and policy roles at central banks elsewhere. As you know, one of the big challenges right now is that many emerging markets are going to have to restructure their debts, especially the very low income countries as we speak, even though the pressures aren't there in the short run. I think these are questions that I think a lot of minds in the world will have to get together and try to sort out. I hope I have a shot at doing some of these things. We'll see. Thank you, Gagan, for the great set of questions.
Well, thank you again. And Vinay, hand it over to you for Q&A.
Thank you, Gagan. I hope everyone can hear me. Thank you, Gagan and Viral, for a very insightful and engaging discussion. If the number of questions are any indication, the hundreds of attendees who have signed up, we would be here for a long time. So we'll try to take as many questions in as possible. And I before I do that, I did want to start on a personal note as well. Viral, you may remember, I used to play cricket, and he was actually our sheet anchor role that he played when he was doing his PhD at NYU. So very glad that you could make time today to do this. So let's dive right into the questions. And what I'm going to do is there are a bunch of questions on policies. There are some questions on digital currencies, some on macro. So I will try to bunch them together, but there are a few questions that have been voted up quite a bit. So I'm going to read them as is, and perhaps we will go down that list, and some other questions I may just bunch them together. Also, for today's talk, we have a lot of participants who are IIT Bombay, but also non-IIT and friends of IIT Bombay, spouses of IITs and families. So great, and also noted economists who are on the chat. So if there are any questions from them, I will direct them to you. But the first question actually comes from Ram Kelkar that has been voted up. So what do you think about the new agricultural policies that the economists have been described as helping prune regulations and stifling farmers? How can it help open up the sector and help it become more efficient?
Yes, I'm yet to study the bills in their full detail, but I can tell you from my personal visits to several states during my RBI stint. I used to be in charge of human resource management for a while. So I had to go to our regional offices, and I always used to spend some time around to understand the local economy there. And in several states that I visited, they made it very clear that essentially the middlemen, the wholesalers, especially between the retail farmers and the final sale of the farm produce to the buyer, the consumer, the middlemen are actually the ones who are making a huge price cut. Very often, this middlemen, that whole sector is very concentrated. It's also very often politically connected to in that local region, either to the state administration, the government, or whoever might be the powerful people locally. And so there has been a view all along, if you spoke to farmers on the ground, that the benefits of the farm packages don't reach the retail farmer, and they earn very little actually relative to the final produce prices. I think, as far as I can understand, the Farm Bill is an attempt to actually empower the retail farmer to be able to sell more directly to the end users, of course, to the markets where the produce will be sold, rather than it being an institutionalized, concentrated middleman sector that has been in place so far. Now, to that end, I think this would be good. It can actually help reduce the intermediation spreads between what the farmer is getting and what the end user is producing. It should bring overall prices down and yet allow the farmers' returns from farming to go up. If that happens, it will bring down food inflation. It may also actually allow the government does what is called as minimum support price packages. They procure especially rice and wheat in very large quantities and store it so that when there are shortages, they can release these grains from the Central Food Granary of India, the Food Corporation of India, in order to stabilize the prices. But right now, even the benefit of this minimum support prices is getting entirely eaten up by the middlemen. It's not actually reaching the end farmer. So I think that's what they are trying to do. I think some of the protests are probably a reflection that some of these middlemen will get displaced. And of course, there could be some issues about whether adequate consensus was built before the packages went through or not. I wouldn't know the gory details of that. A last point I would make here is that several items have been taken out from the essential commodities list. But there, I think there have been slightly mixed signals, because in the same week where some items such as onions were taken out of the essential commodities list, simultaneously the government imposed an exports ban. And this has been one of the problems with the farmers, which is that they find that India's export policies on food grains are so unpredictable. The moment the onion price rises, and in fact at RBI I used to call it the Pav Bhaji index. The tomatoes, potatoes, and onions, they are very important parts of India's consumer price inflation. So whenever the Pav Bhaji index goes up, immediately you would see export bans. Now, you can't have a farmer who has done his planting, etc., at the beginning of the year in anticipation of some demand, suddenly facing a big shock to his ability to supply to his customers, because then he has to look for the domestic market suddenly and alter his entire supply chain requirements and so on. So I think it's a step, it looks to me from whatever I've studied so far, a step in the right direction to take out the middlemen. I would say that the government also needs to get out of these export bans and other kinds of restrictions as much as possible, so that farmers have a predictable policy rather than what looks to be very fickle, knee-jerk reactions to a rise in the Pav Bhaji index, as I call it.
Thank you, Viral. That the Pav Bhaji index is a great. I know you're known for your witty remarks and Kishore Kumar song responses. So thanks for that. Also, in addition to questions that have come in through Q&A, there's been generally some questions have come in through write-ins, etc. So I'm going to pick that question up. In general, obviously COVID-19, we see sort of, just like GFC, it was a pre-GFC and a post-GFC world. There's going to be a pre-COVID and post-COVID world. So what are your views on sort of India's our outlook for India's growth in the post-COVID-19 world, and if you can sort of broadly address that?
Yes. Yeah, it's a difficult one, but I'll try to give my sort of brutally frank answer on this, which is that I think we are out of options right now other than to reform in a very, very big way. I think we had the liberalization reforms of early 90s. We had the divestment program of 98 to 2003. We milked that. These were low-hanging fruits, and we have benefited from that. The last 10, 12 years, in my opinion, have been a bit of a regression. As I said, the global growth slowed, and we have moved towards fiscal dominance policies to try and repress the private sector, the banking sector, the regulators, so that everything is helping the government run its populist programs. We need to now really have a course correction. And I think it's going to require fiscal and financial stability reforms, which I already touched upon. It's also going to require serious real sector reforms. I think we can't actually divert China supply chains to India without actually the foreign firms being able to acquire land in a very easy manner and a transparent manner. So we need land rights and records and registries to improve. Labor reforms, some progress has already been made. Perhaps even more needs to be done. Why not a more unified single code, for example? Perhaps that's the next step. But at least some movement has happened along with the Farm Bill in that direction. And third, I would say India is spending far too much on providing subsidies of all types. And what happens is, take the farming subsidy that I mentioned, the minimum support price. A lot of it is not even reaching the end farmer. It's getting eaten up by the middlemen, the wholesalers. These are not poor people. These are actually fairly wealthy entrepreneurs themselves. So when you take into account several of the subsidies, a lot of dissipation happens on the costs that are incurred, because either it is not reaching the last mile, or the administrative processes are so costly that all the costs are eaten up in the delivery and the financing of the subsidy in the first place. I think India needs to seriously consider a universal basic income, a one direct benefit transfer. And India is right now in a position to do this well, because we have made such a big digital progress in the Aadhaar, the UID, its authentication, setting up the Jan Dhan Yojana accounts. Why not use this entire machinery to actually make one direct transfer? It will be efficient, so it will reduce the total government cost of providing the transfer in the first place. And then that freed up space can be used for significant infrastructure investments, roads, airports, ports, and the like. So my sense is that if India doesn't reform fiscally, financially, and on the real side, treating COVID as essentially like a 1991 kind of a shock, I think if we don't do this, it's going to be very difficult, because our pre-existing conditions were not great. We were slowing down even coming into COVID. Our fiscal deficits were high coming into COVID. Our banking sector was not in great shape even before COVID. And therefore, this should be a wake-up call to do something very significant in a short period of time, so that we can turbocharge the economy to keep maintaining its growth potential of whatever 7.5%, 8.5% is.
Great. Thanks, Viral. I think you answered a couple more questions that were on similar topic. Also, if it's a situation like 1991 where we need to do some critical reforms. So thanks for that. The next question is two parts. It's been voted up. It comes from Anay Joshi. And there is a part of a question which you may consider as bouncer or outside the off stump. So it's up to you whether you want to answer it. But the first question, and I think you've talked about this, what's your take on demonetization that happened? And the second question is, if you can answer that, why did you leave RBI?
On the first question, I'll limit it to the financial sector. I explained in the preface chapter of the book, there's actually 2 pages dedicated to it. And I think it's a slightly different take than what a lot of people generally talk about demonetization. See, what happened with demonetization in the end, as you know, is that the money got laundered. Basically more than 99.99% of the notes were basically converted in through whatever leakages there were in the system. Now that created a huge gush of money into the formal financial system all at once. So, bank deposits actually grew very sharply in a short period of time, because this money was otherwise in the informal black economy, and it all suddenly came into the formal economy. Now, because of the silent banking crisis that I was describing, banks did not have the capital to lend it. And these deposits mainly became a source of a cost, because, when you have more deposits, you have to hold more reserves against them as for prudential regulations of the banks. You have to service the deposits, which is costly, in the branches and so on. So the deposit rates started coming down in India because there was such a huge supply of deposits. And this actually destabilized the non-bank financial system. What happened is that the savers started looking for higher yield, because the deposit rates were giving so little money because of the sudden gush into the formal system. So equivalent of money market funds in the US got set up in India. They are called liquid debt mutual funds. What do? They basically sell deposit-like contracts, because they invest in very safe short-term paper of financial firms, high-rated corporates, etc. Now, the world over, the experience is that when you get too much money flowing into a part of the financial system at once, the underwriting quality just drops. They start giving money left, right, and center without doing the due diligence on who they are actually providing the money to. So my sense is that the non-bank financial crisis that happened in housing finance and some of the other parts of non-bank, they lend a lot against collateral borrowing. So they lend against trucks, they lend against farm equipment, they lend against gold, for example. There were excesses in this part of the system. And in my view, a part of the problem there was the big gush of money into the formal financial system, deposit rates being low, and that creating an yield from search for yield from investors that then flew into the non-bank financial system. On the second question of why I left, in the end, I had to take a call on what is the best way that I can contribute. I was quite concerned about the fiscal issues in India. I thought that the fiscal and the financial had sort of become joined at the hip, so to speak. Central banks are often not allowed to express their opinions as freely on fiscal issues. Of course, I had a personal situation to factor in. My wife and son were in New York. I was in Mumbai. So when I put it all together, it seemed that perhaps it was time to vocalize some of my learnings, especially about fiscal dominance, the importance of getting the fiscal back on track. And I felt that this could perhaps be better achieved by being outside the central bank rather than inside.
Sure, thank you. Thank you, Viral. So I'm going to ask a question from one of your friends and industry colleagues, Samiran Chakravarti. Samiran is, the chief economist at Citibank in India. And his wife actually happens to be an IIT Bombay alum as well. So thanks, Samiran, for joining. But his question is, you've been critical of evergreening in the past. And how would you evaluate the post-COVID widespread loan restructuring scheme announced by RBI? One, is it more taking the can down, or this time it is different?
Yeah. See, clearly some restructuring is required, whether it happens out of court or whether it happens inside the bankruptcy code. Now, of course, the insolvency and bankruptcy code right now is not taking fresh cases because it's not allowed to by an ordinance of the government. So out of court restructuring in a way is the only option to soften the blow on parts of the real economy where COVID has explicitly affected the revenue stream very significantly. I think the key question to me that is not being asked as much as I would like is, how are the banks going to bear these losses? Clearly, restructurings will in some cases be because it will turn the firm around and maybe the bank will get more than what it would have got otherwise, but it will probably still make a loss. It may get more through restructuring than by leaving the debt in place. In some cases, it may just be that the firms will simply not be able to recover. This idea that every sector and firm that is affected by COVID will post-COVID recover to as good a level is, I think, a bit too rosy in my view, because certain sectors are going to see fundamental shifts. I think e-commerce is going to take away a lot of the retail sales that were taking place. Similarly, if you look at travel, hospitality industry, many people are saying it's not going to come back to pre-COVID levels until 2023-24. Now, if these shocks are so long-lasting or permanent, banks will make losses. Non-bank finance that is lent to these firms will make losses. Are we providing capital and asking them to raise capital? If it's public sector banks, either asking government to raise capital or asking it to divest stakes so that banks can bear these losses. And I don't see this being a part of the package. To me, a restructuring package has to be combined with a recapitalization package for the financial sector. Now, why is this important? Because if the banking sector is not well capitalized, then when we are trying to emerge out of COVID, there will be healthier borrowers, healthier parts of the economy that will need to invest, employ more people, help pick up on the growth impulses and accelerate growth. They will need financing. As I said, if you have an undercapitalized banking system, they only do two things. They either evergreen, so they lend to their legacy borrowers so that they can extend and pretend, or they lend to the government because, that doesn't require any extra capital and, it's relatively safe. So that middle tier of healthy firms in India is always getting creamed out. They are always paying extraordinary term premium or risk premium, because that's a manifestation of the undercapitalization of the banking sector. Large private banks in India have gone and raised capital on their own, but I would like to see a more decisive move towards ensuring that losses incurred in restructuring are written off by the banks, so that when we come out of COVID, they have the capacity to lend well and at reasonable costs to the healthier parts of the economy.
Thank you, Viral. So the next question is also comes from Ramesh Narayan, and it's worded up quite a bit. And I'm going to expand that so that I can cover a few other questions in there. So his particular question is about monetary easing in the United States and the increasing the deficits by multiple $trillion. So obviously this is a US focused question, but also sort of coming from outside in, I would add, based both on the monetary side and the fiscal side, there have been a lot of stimulus that's provided in the US, in Europe, and across the globe, especially in the COVID world. And depending on which numbers you believe, and depending on whether the HEROES Act gets passed or not in the US, we may see upwards of $7 trillion of total capital injection, both fiscal and monetary. Similar figures coming out of Europe also. So what's your view on this expansion of balance sheets and all the fiscal stimulus that's been provided? How long does it go? What impact will it have downstream?
Yeah, of course, it's a very tough situation for policymakers. So it's easy for me to be outside and wax eloquently about what they are trying to do. But let me still make perhaps 2 points. First is that I think most people would agree that fiscal measures are required in a shock like COVID to provide relief and repair to the most affected parts of the economy. There are studies coming out which are showing that above median income households, the employment and earnings outcomes in the last 6 months in the US have actually been relatively fine. There is not that big a loss of jobs or of earning income. In contrast, once you go below median income, the curve of both employment level as well as the earning power has dropped very precipitously as you keep moving to finer and finer, weaker bin of pre-COVID income level. So I think monetary policy can't do too much. Monetary policy doesn't reach the last mile household of the economy. I think this is a lesson that we need to learn from the global financial crisis, that monetary policy trickles down very, very gradually. Even when it trickles, it requires a very healthy banking and financial system so that they are able to make loans. Typically, when you come out of shocks such as global financial crisis or COVID, the financial sectors are themselves trying to repair their balance sheets, and the last mile lending is not actually that attractive to the borrowers. So I think fiscal policy to me is the right tool, but it needs to be directed in a more targeted manner, even in a country such as United States, in my view. And I'll just give a personal example. Last year, my income was very low because I was at Reserve Bank of India for most part. So I'm actually one of the recipients of the United States government administration's relief check. I really don't think I should have received that check. There's absolutely no need for someone like me to get the check. Now, of course, we have passed it on to others who are providing services to us. But I think that shows the level of excess in the program to an extent. I think it should be much more in quantum at the very low level, in my view. I think that is where the hit is the hardest. That is where essential consumption probably is getting compromised. So both from a consumption standpoint as well as a humanitarian standpoint, in my view, the fiscal aid needs to be more targeted at the last mile where the impact on jobs, etc., has been the greatest. Now, of course, there's unemployment insurance and so on in the United States as well. I think the second point I would make is that I do think that the central banks need to tread here very, very carefully. See, they've gone on a limb after the global financial crisis through quantitative easing programs. And, even the normalization from that didn't happen fully in the United States, even though it embarked on it. In Japan and Europe, we didn't even normalize. We were actually still continuing to expand the unconventional policies. In one way or the other, they have made it very easy for the governments to borrow. They have made the government borrowing costs very cheap through their large-scale asset purchases, at various maturities all along the yield curve. So now, on top of that, already there was a fiscal excess on the balance sheets after the global financial crisis. Now, on top of that, additional 10 to 20% of GDP has been added as extra borrowings on the government balance sheets. The central banks need to be careful, because this was the point Gagan made, which is that fiscal dominance is now coming up in the discussions, even in developed economies. I have not heard the word. I wrote my chapter pre-COVID. I never expected that in the last 6 months, I would hear the term fiscal dominance in the context of developed economies as much as I've heard it in the last 6 months, because they are all asking the question, if a vaccine is found, whenever it is found, and the pent-up demand post-vaccine actually starts restarting the economy very strongly, private credit demand comes back up, the governments are going to have to keep rolling over their huge quantities of debt. What will the central banks do at that point? Will they sidetrack inflation altogether and say, I'm fiscally dominated, I have to help the government tide over its finances? Or will they actually take corrective measures to recognize that inflation might pick up at that point of time? Or if inflation picks up at that point of time, will they go back to their inflation targeting mandates in the way that they were meant to? I think this is a key question. We are seeing it in data. Investor expectations of inflation have risen in the last 6 months in spite of the growth slowdown. And that begs the question as to why. And I think it is because they are fearing that when the debt burden is very high, post-vaccine, when the private growth increases, the central banks, there is a chance now that the central banks may not cut back on inflation as quickly as we would have expected them to be. So I think it is something the central banks have to watch out for. Ideally, they shouldn't lose their credibility and commitment while trying to give the economy a soft path along the way. So it's a very difficult balancing act, as I mentioned. I would not want to be in their shoes, to be frank, given the complexity of the tasks at hand. But let's see. We'll see how it plays out.
Thanks, Viral. Thanks for the great answer and a good question too. Thanks very much for that. There are a number of questions. I also want to be mindful of our time. We are close to our closing time, but if you're okay, we can extend and take in a few more questions.
Sure. I'm okay, Vinay.
Yeah. So there are a bunch of questions that have come up on digital currency, which I'm sure you've been giving it a lot of thought. So I'm going to combine those. One question that has comes is there. Hang on. So what are your views of sort of central banks, adopting and actually actively promoting digital currencies? And that the digital currency being one part, the crypto and crypto assets, they're not really currencies, is the other part. So would love to hear your views, and that will also cover a lot. There are a few questions on that. So if there are any follow-ups, we can take them later.
Yes. Yeah, it's a complex topic. I should confess at the outset that this is actually not my core area of expertise. So if I say something that doesn't make sense, it's because I'm actually not making sense. If you just keep it very simple, there is both public money and there is private money in any economy. What do I mean by this? I think of money as a store of safe asset. Now you can keep it in the form of the bill of the government. Say in India, it's the rupee bill or it's the US dollar here. But sometimes we just keep our money as deposits in the bank. We think very often it is as safe as actually something that's backed by the tax collection powers of the governments. So people use both public and private mediums of exchange because money is primarily there, as I was explaining to Gagan, to help lubricate financial flows. It has to travel along various arteries of the economy, helping different organs of the economy to function at their peak capacity, so to speak. Now, technology has made a new kind of doing transactions possible, which are these digital currencies. I have my concerns that some of these media of exchange are popular because they probably allow sort of informal activities such as uh, you know keeping your money in black or doing other kinds of illegal activities. Nevertheless, it's hard to deny that in times such as COVID, for example, when physical transactions have become harder, actually being able to do digital transactions in one way or the other has been actually quite an advantage. Now, I think of digital currencies as a possible continuum on that continuum of technological migration of financial transactions in the economy. My view is that because the private money will be hard to stop from transacting in the form of some of these digital forms, there will be no choice ultimately left but for the central banks to provide their own digital version as well. Because what happens is, if the demand for private money becomes too high and it is more convenient to transact in the private medium, which could become some of these digital currencies, you ideally don't want that a big part of the economy is happening through a medium of exchange that is not in control of the central bank slash the governments in any way. Because then when you have to restart the economy, suppose there's a cyclical shock, how does the central bank get the economy to come back up? It uses rate cuts or injects liquidity, hoping that the banks will then transmit that liquidity through their intermediation to the various arteries to the different parts. But now, if all of that is happening mainly through private money rather than through public money, then it becomes hard to have these forms of transmission. So, at the cost of sounding a bit abstract, what I'm trying to say is that I think of this not as that path breaking and innovation. Private money has always existed in the world. I think these digital currencies are a technologically enabled new form of private money. It has its own share of problems like black money, even with cash. That problem will be there with private digital currencies also. But most likely, the central banks will have to respond with a central bank currency of their own. And we are likely to see coexistence of these two forms, with the central bank always doing enough through the central bank digital currency to be able to have a meaningful impact on the economy through its policies when it wants.
Okay. Thank you, Viral. So there are a couple more questions. There's a couple more questions on microeconomic. So I'm going to combine a couple of them together. The question is, what are your views on ideas where the microeconomic level solutions can possibly alleviate the well-being of the citizens' households? And one example the question gives is the Grameen Bank, where the innovation can actually take more of an ownership in their own right in the smaller communities or individual level. So what are your thoughts on that? And sort of not exactly related to that, but related to banking also is, there is a big move in the PSU in the public sector undertaking banks in India, where they're all being, they're ailing and they're different organizations, but they're also being amalgamated together or put together. So what are your views on that?
Yeah, let me answer them separately because I think they are slightly different questions. See, the first question is, it's spot on. At the last mile, the lending happens in those forms. I visited actually the units of one of the microfinance institutions in India on the outskirts of Kolkata. And it does the commitment to repay the loan really comes through a social stigma of not repaying the loan in a self-help group or in a group of micro entrepreneurs, typically women in these parts of India. That delivery of the loan in a group and then its recollections right in the middle of that semi-urban or rural area is absolutely important. That is what creates both a willingness to lend as well as the willingness to repay the loan. I'm a big fan of this kind of last mile lending. I think it needs to be facilitated a lot more in India. And in the book, actually, there's a whole section through a push I made during my term on creating a public credit registry. And the example I like to give is, suppose my book someone wants to buy, they don't have exposure to it before. But yet through the Amazon's rating for the book, the transactions that have happened in the past, which are all encapsulated in the Amazon ranking, there is qualitative surveys of the past readers. All of that registry provides very valuable information for a potential buyer of the book to decide whether they should really spend their money on this volume or not. The same way, a last mile borrower in India should be able to demonstrate the pattern of their cash flows, their past track record of credit transactions. And the more we formalize and digitize these transactions at the last mile, the more they will be able to tap into potentially newer lenders. Right now, they rely mostly on branches of banks or of microcredit and microfinance institutions. But see, the paradox of India is that on the one hand, we have 10 lakh crores of bad loans, and yet we have only 60% debt to GDP penetration, which is very low compared to 100% plus numbers in most developed countries. We are more in line, I would say, average to below average, even within emerging markets. Now, to have had public sector banks for 50 years and then to have such a low credit to GDP ratios, to me, is a sign that it isn't working. So we need newer players at the last mile. Is fintech the way to go? Where will they get the data from on the borrowers? So what we have proposed, and RBI is in the midst of implementing it, is a public credit registry, which will carry a full origination to end credit information on any contract that any, even a small ticket borrower is engaging in. And then it will have interfaces to other data sets. If you are a micro entrepreneur, it will connect to your GST network invoice. It will be connected to your utility bill payments. Maybe in future, it can even be connected to the cash flow structure of your money going in and out of your mobile wallet. Now, the user has to have control over the confidentiality of this information. So if the borrower wants to give consent for the information to be available to a potential lender, then the public credit registry and the ancillary infrastructure should allow such consent-based sharing of information. I think this could be a game changer as far as financial inclusion at the last mile in India is concerned. I'll keep it short on the amalgamation of public sector banks. What are the pros? The pros are that there were too many of them, and sometimes it was hard for the government to even appoint all the members on the board, the top management, executive directors, etc. So very often they were working with very depleted pool of human capital at the top. That's clearly not a great scenario when so much taxpayer money is at risk. So amalgamation has helped a little bit with this human capital problem. Second, what it has helped with is that when a bad loan is getting restructured, say out of court or even in bankruptcy, you need certain kinds of intercreditor agreements to be signed, because all the creditors have to agree that a certain haircut is okay to take on this borrower's loan. The fewer players they are, the easier it is to get that done, because then coordination is much more easily achieved. What is the cost? The cost is that this looks cosmetically just like combining balance sheets without changing the economic size of the public sector banking sector. What India needs on a bigger footing, in my view, is for the government to get out of these big imprints it has in banking, insurance, power finance, and so on. It needs to get out so that private sector expertise, both in management and ownership, can actually be brought into these entities. And most importantly, so that the taxpayer money is not being lost here. Instead, it can be used now to provide the repair and relief work to come out of COVID.
Thank you. So, Viral, given the time, I will take the last three questions here. This one comes from Piyush Jain, and this is related to the fiscal stimulus. The government wants to pump close to $1.4 trillion to revive infrastructure. So the question is, how would this get funded, especially given the current situation, and also how will this get funded even at the state government level, who are supposed to balance their budget? So your take on that?
Yeah, absolutely. I think that is the challenge. Where is the space? Where is the space to spend money on where the money should be spent? It's because we have done so much which doesn't generate very long-term returns. corporate bond markets, markets for infrastructure finance don't grow in India because the government has dissaved all the domestic savings. The households save between 7 to 8% of GDP in India. The government dissaves 10% of GDP in India. So who else is going to supposed to get financing from and from where? So I think the fiscal institutional package is a must. Needed essential expenditures are getting crowded out in infrastructure. Private sector is borrowing at very high costs because the government is dissaving so much. So we need a macro rebalancing for the government to do less and do it more efficiently. And therefore, those 3 points that I mentioned. All that I would say is that if infrastructure expenditures are undertaken, we need better capital structures for it. What is the number one problem why infrastructure projects in India get stuck is because government clearances don't come on time. So that creates a tremendous uncertainty in the maturity of these projects. Now, when you have that kind of uncertainty in the duration of the cash flows, it's very hard to fund it with loans. You need to be able to fund it with more equity in the capital structure or more long-term. It has to be very long-term finance. So I don't think banks will be the very natural vehicles to do this. I think this money has to come from markets, probably insurance companies and pension sector. But to do that, the repression of the insurance sector and pension funds in buying government bonds has to be reduced. Because if they keep buying the standard government of India securities in big chunks of their portfolios, they are not going to have space to buy the infrastructure bonds that are being issued. So I think whenever it all, to me, the reason why I said fiscal to me is the big elephant in the room, because whenever I try to do the macroeconomic accounting of where the money is going to come from, the only answer I can reach is that the government has to shrink so that there is more space for others to actually fund other people in the economy.
All right. Thanks. So the next two questions, one is a very open-ended question, which comes from one of our board members, Uday, and the one after that I'm going to take is very specific to ICICI. But let's go with Uday's question is why. His question is, why has India remained so poor as a country for so long, and it continues to be so today? And if I may expand on that a bit, are there any models? Obviously, China is one that India can follow, or if there are any other models from rest of the world that we can learn from and follow.
Two things. One, Uday, I would say we have made significant progress since 90s, of course, in eradicating poverty by significant margins. And I say that because I think we should do deep introspection as to what we did after 90s and why it has allowed us to actually raise the average levels of income in India. And I think it's because we moved away from the centralized, nationalized structure of 70s and 80s, this Hindu undivided family, so to speak, which was basically just allocating resources very poorly. I think if we want, with our level of government capacity and bureaucratic capacity, if we want the nation to become nationalized and centralized again, I don't see how we can grow at more than 3 to 3.5%, the so-called Hindu rate of growth of 70s and 80s, as it used to be called. I think what we have to realize is that the only time we have succeeded in eradicating poverty is when we have adopted liberalization and divestment reforms. And I think this is the lesson we really ought to learn from our last 3 decades. To some extent, I feel why we have remained so poor, I think it's partly because of our own choices. I think we have always had a slightly hesitant approach to moving away from state control. I find it sometimes even in the psyche, deep in the psyche of the Indian citizen, there is this immediate reflection when a problem arises that the government must fix my problems. And I think it's a legacy problem of having had 4 decades of, I think, a nationalized system post-independence. I think we need to find more private solutions to our problems. I think we need to allow markets to flourish. I think less of the government will be more for the rest of the economy. The government should focus on public good provision, education, health, infrastructure. To me, these are the 3 critical things the government should focus on. And I think if we do that, given the demographics we have, given how hardworking the country is, and given how aspirational and entrepreneurial the youth are, I think we can still get back onto the right track. I think the last 10 years, last 10, 12 years, in my view, are a bit of a regression towards the 70s and 80s compared to the 90s and the pre-global financial crisis era. What was the last question? I forgot.
So the next, I'm going to repeat
Yeah,
it,
yeah.
and I'm probably going to expand it. It comes from Hemant Bhimnathwala. And by the way, Viral, the questions are keep pouring in, so we'll be here all day, all night. So we're going to cut it off at some point.
Yeah.
So this, we talked about public sector and sort of RBI's role in governing, especially the private sector bank. And the question really comes to how do you address the credibility issues of private banks here, especially given shocking news, say, coming out of ICICI or Yes Bank, for that matter, and great institutions, but obviously some of the risk controls were lacking there. So what does it do to the credibility of private banks and the regulators?
Yeah, see, there will be failures in a private system. There'll be failures in firms. There'll be failures in banking. There will be failures. There will always be failures, some supervisory failures. To expect the regulators to be in every nook and corner of the country, knowing exactly whether a loan is good or not, is almost impossible. So my question is whether, when a failure occurs, whether remedial actions can be undertaken in a quick way, and whether the incentives upfront are right or not. So sometimes I agree there have been governance failures. Let's stick to private banks, for example. There have been idiosyncratic governance failures, but I don't see it as a systemic problem. We also have extremely well functioning and well performing and well valued private banks in the Indian markets. In fact, in a recent analysis that I put in a Business Standard op-ed, I showed that the public banking sector needs about $70 billion plus of capital, whereas our private banking system as a whole is surplus by that much of capital, even if some stresses were to materialize. So there are parts of that system which are very well capitalized. Second, when governance problems have happened, it has been possible to correct them because the RBI has the powers to let go of the management and change the ownership structure of these firms. In contrast, when problems happen at public sector banks, one, they are across board, and RBI has no powers. RBI cannot replace management of public sector banks. RBI cannot force capital raising by these banks by dilution of government stakes, because the government has a dual control over these banks. And this dual control, to me, is the fundamental Achilles heel of our financial sector, that there is a large, more than 50% of deposits and loans and more than 80% of the losses are with the public sector banks. And there is dual control, so the regulator is not able to address it. This is not to say that the regulator is perfect, but its ability to even achieve the outcomes that it achieves for private sector banks are not available. The last point I would make here is that it also shows, though, your question is important, because it shows that there is no substitute for good governance in the end. So to think that just privatizing public sector banks is going to be the end of it, no. Is the government truly at arm's length from these banks, even after it has diluted its stakes, say, to 30%? Or when it has reprivatized, does it still implicitly function as though it has control? Think of the Fannie Mae and Freddie Mac in the United States. They were privatized. They were listed on the New York Stock Exchange in late 60s, and then Freddie Mac eventually. But the government did not give up control of these entities. And ultimately they were big contributors to the subprime housing mess and the housing bubble that got built up in the United States. So it is important that the government do two things, both of them, which to dilute stakes, reprivatize, but also genuinely get out of the operations of these banks, because that is the real compromise in the lending standards, directed lending to preferred sectors. In a recent piece that we have just put out with Raghuram Rajan, the two of us have written a piece on how to reform Indian banks just on Monday, actually. We are trying to explain how some of the governance practices can be changed at public sector banks, along with a movement towards their eventual reprivatization.
Sure, thank you. So we'll take one very last question, and coming back to your book in some way. So I want to come close on Anand Kumar Chopra's question. What's your take on on when and how the silent banking crisis that you talk about will be audible to all. And so if you can comment on that, and we will, yeah.
Yeah, I think it is audible to all. It has been audible now for at least 5, 6 years. In a way, the lament in the book is really that why is it that for a short window of time, I explained in the preface chapter that it looked like for about 10 months after I had joined, we were making giant strides in actually arresting this problem, taking the bull by the horns, so to speak. And yet, when the electoral pressures, short-term pressures rose, we kind of did a very quick regression on these very important foundation laying for financial stability for the next decade or longer. I think we need to distance the central bank from the government. I think we need to distance the government from public sector banks. We can't have the Hindu undivided family arrangement between the government, the central bank, and the public sector banks anymore. The three need to operate as independent but coordinated wheels, so to speak, along with the real sector. Right now, what is happening is the entire engine of the economy is gradually shifting more and more towards just one wheel, which is the wheel of the government. And you can, just by that analogy, you can imagine a car that is trying to drive itself on one wheel, how far it can go. It needs to work in tandem. It needs to create space for the central bank, the banking, and the real sector to be able to borrow, govern, and lend with the right levels of due diligence, discipline, and recognition of the risks, so that we are actually powering on a more steady and sustainable pace going forward. The book, in a way, it's all about striking this right balance. I think that's the main message. If I could just take a minute extra, Vinay, I want to leave you all with, which is that, in my view, what has happened in India is that we have gradually lost the benefits of the reforms of 90s and 2000s. Fiscal deficits were coming down, growth was high, household savings were increasing because the real wages were actually increasing. All of these gains are now dissipating. And instead of doing something transformational in reforms about these issues, we are cutting corners, we are taking shortcuts, we are playing T20s. And I think we need to keep our focus on the long run, not be in a state of panic, but realize that the best way to move forward is to first figure out where we want to be, take the fiscal, banking sector, and the real sector reforms to build a bridge to that point. And once we have a clear bridge, we can actually start walking along that or moving along that in a smoother way. If we don't keep that long run target of where we want to be in sight, and we keep running helter skelter looking for short-term fixes, we are not going to cut it. And I think time is running out, but sometimes crisis presents an opportunity. And I'm hopeful that the COVID may have actually helped accelerate and escalate some of these issues right to the top, so that we can do what is needed on the ground and move ahead. So I want to end on a positive and optimistic note. As I told you, I was waiting for the global financial crisis. So I wouldn't say I was waiting for the pandemic, but I want to think that the stresses that the pandemic has economically imposed on the economy now presents a valuable opportunity to address what were our wrong initial conditions even before the pandemic. Sure. But also, of course, I want to end on a note for wish all the families and your loved ones the very best of health and safety. I do hope that Indian curve is gradually reaching its peak, and then it starts declining steadily thereafter. We witnessed it in New York. When it happens very quickly. And I hope that this kind of recovery can take hold in India very, very soon.
Sure. Well, thank you again for a very insightful and engaging discussion. If questions that are still pouring in is any indication, we could go on. I also wanted to thank Gagan for really expertly conducting the session with you. I think that it held our attention. A lot of things came out from that discussion. So thanks a lot. I also wanted to thank my colleagues here from Heritage Foundation, especially DC, Uday Nadkarni, Paraswil, who helped put this chat together, and also the board of Heritage Foundation, which has supported. Also, of course, more importantly, to all the participants from around the globe who took the time out on a Saturday to participate in this, and and continue to be engaged. So thanks a lot, everyone. We do have another session coming up by the end of October. One of our alums, Anurag Mairal, who is a professor at Stanford, will be conducting a panel discussion on healthcare, especially in the post-COVID world, and healthcare for engineers to be particular. So it should be a very interesting one. So stay tuned for that announcement. And again, on behalf of Heritage Foundation, I want to thank everyone, especially Viral and Gagan, for participating and sharing your thoughts. Thanks a lot, everyone.
Thank you so much, Vinay. Thanks, DC, Gagan, Paraswil, Jignesh, Ron, all of you for the opportunity. It's always satisfying to come and join the IIT gang, IITB gang. Sorry, I can't see all of you, but I can see some of the texts which are coming up. So hello to everyone. Stay safe. Take care. Bye.
Thanks. Bye.